I've invested more than $5,000 in this one Canadian stock that's dropped more than 15% in the past 3 years. Now, this might be scary for some people, but I love when stocks go on sale. I'll also reveal the top 5 companies I have in my one portfolio, which is my kids' registered education savings plan. And I'll also reveal, the one company that I need to rip the band-aid off and what I'm going to do. Now, the company that I have spent more than $5,000 in the past month is Fortis. Now, this company has dropped more than 15% in the past 3 years, but that is supernatural in a high interest rate environment because it is capital intensive, meaning it requires a lot of moolah to actually service this company, which is a utility company. With these companies that have to service a lot of debt, a lot of capital to service the company, well, guess what? The stock will plummet when the interest rates go up. But there's a light at the end of the tunnel. Bank of Canada is holding interest rates. Now, just crossing my fingers, hoping inflation is going to stay steady and, of course, slowly drop over the year. Then the interest rates will follow. I speculate that Fortis is going to go back up. Now, why I love Fortis is because this is a beloved Canadian dividend growth company, which means a company that's paid its dividends and grown its dividends, which is moolah that you collect just for simply holding onto the company for more than 50 years. In its recent forecast, it is expected to grow its dividend 4 to 6% over the next 5 years. And it's planning to spend more than $25 billion growing the company. With a new $25 billion injection into the company, which is a couple billion more than it has spent in the past 5 years, that means it's going to get more contracts, which means more revenue, which means more moolah. Another thing I really look for in this company is the safety of the income that's collecting, which is this dividend income. So I look at the dividend payout ratio, which is just telling you, can it afford to pay out the income for the foreseeable future? And I want a payout ratio of less than 80%. And as you can see, Fortis is 73%, which checks it off. I'm fairly confident when my kids go to university, they're going to be so happy to collect this income from this company just for simply holding on to it. I'm hoping that in the future, when they collect this income, they can use it to offset some of their tuition or their expensive book fees. Now, as happy as I am for the company to make its biggest capital injection of $25 billion back into the company, making some new acquisitions, I'm also wondering, where are they getting this capital? Which leads me to 2 red flags I am seeing. They're fairly minor, but still, there are 2 red flags. Number 1, to service this type of capital, they got to actually raise the capital, which is actually increasing their debt. That means they're increasing the number of shares in the company, which was one way a company gets more money. So unfortunately, it is increasing the number of shares in the stock market, which means that each share isn't worth as much as it did in the past. The second thing, in order to raise that capital, well, they're going to have to take on more debt. And as you can see, in the past few years, the debt has been increasing year over year. Now, am I worried? No. Because this company has been existing for a very, very long time, and it survived and thrived during periods when interest rates were double digits. So there might be a little bit more short-term pain before we get long-term gain. Now, as promised, I want to reveal the top 5 companies I hold in my kids' registered education savings plan. The first company is Microsoft. I've been buying Microsoft in my past videos. I've been sharing it all along, but super transparent. I love the direction of Microsoft, and I totally think this is a recession-proof company. The next company is a boring bank, which is TD Bank. Now, I've been investing TD Bank because it's been getting killed over the past year, a year and a bit. So, like I said, I'm a bargain hunter, so I've been investing quite heavily in TD Bank in my kids' registered education savings plan. The next company is Tesla. Sure, and I love the direction that Tesla is taking, which is in robotics, electric cars, batteries, and artificial intelligence through its full self-driving software. As you can see, there's a big theme in my kids' registered education savings plan. I've been looking at more AI-related companies, and I'm looking for companies that have a very, very good future. The next company is, there it is, which I'm not going to talk about anymore because I already gone over it. And the last company is Apple. Now, Apple has made an amazing run. The only reason why this company has had the biggest return in my kids' RESP is because it is the first company I bought within my kids' RESP fund. Now, you might notice a theme in my kids' RESP fund. There's a lot of tech companies. When I first opened this account, I figured my kids have a lot of years ahead before they go to university. Now that my kids are 13 years old, that means university is getting pretty close. So I've changed the way I've been investing, which is buying heavily into boring companies like Fortis, like TD Bank, to offset the volatility in this account. And I've been buying into the S&P 500, which is 500 of the biggest companies in the stock market. All this is going to do is to help balance the erratic behavior in this account. Because when the stock market goes down, my kids' RESP fund is not going to look so healthy. So I got to ride it out. Now, there's one company that I need to rip the Band-Aid off, and that is Algonquin Power. Now, if you want to know why I want to sell Algonquin Power, I've made videos about this in the past, and that's because it was acquiring way too much debt. And in a high interest rate environment where you're servicing a lot of debt and your dividend payout ratio is like already not looking healthy, there's a very high risk of a dividend cut. What that means is that the income gets cut, and guess what happens to the stock price? Which drops. I've actually sold a ton of Algonquin Power stock in my other portfolios, but in my kids' RESP fund, I haven't found another opportunity where I'm willing to sell the shares and trade it for something else where I need the money. I'm just a bit lazy because there's no tax write-offs. When you lose money in your kids' RESP account, unfortunately, you can't harvest that loss. It's just something you just have to swallow. Now, I remember at a time I was meeting up with my financial advisor at a bank, and I remember walking into the hallway, entering the door, and then sitting on this creaky old office chair and leaning over on the desk and just peering over a ton of papers. And as going through the papers, my eyes were getting glaze-eyed because there's so many numbers, so many graphs, and the financial advisor was just basically talking mumbo jumbo to me because frankly, I was lost in all the technical jargon. How many of you can relate to this? It absolutely sucks. It took me years to learn all the financial terms, to get comfortable and confident with investing in the stock market, which is why I show up every week on Financial Nirvana Mama to help you become financially smarter every single day and create multiple sources of income. So please, if you got to the end of this video, please hit the subscribe button, follow me, and check out these other playlists. And if you want to learn more about the RESP fund, check out this video up here. Bye.